Actually, as far as the urban transit monetization is concerned, I have been connected with the urban transit in two, three ways. I was a person who manufactured the Kolkata metro rakes in uh, ICF Chennai. In fact, it's the oldest metro system in the country. Then we this air conditioned EMU for the Bombay suburban and the about 200 rakes when for including Bombardier and Medha. In fact, Mr. Dhingra was the country head of Bombardier when we bought those propulsion system for Mumbai suburban rakes. And in addition, I have been associated with the development of the station because urban transit system includes the station, and we had two institutions in this way: IRSDC and RLDA. So, what my experience has been that ultimately it's a public utility. You cannot go beyond a particular limit. In fact, there are letters of the government of India also. The most successful monetization has been selling government land on long lease, and so or selling the space. Even in fact, we tried to sell the Ahmedabad station. So far in the stations, only the Habibganj station has been success story. Otherwise, everywhere else now we have decided that we will award the contracts for station redevelopment on a EPC basis. And once the asset is ready, that will be leased out for the use because private entrepreneurs still till today are not are a little bit restrictive about there are so many unknown areas are there that they find it difficult to put their capital there. As far as the rolling stock is concerned, fortunately through IRFC and every loco, in fact 85% of the rolling stock which is running on Indian Railways today are hypothecated to IRFC. So they are in effect already hypothecated. In fact, all our railway projects uh, are now the funding is from the we in railways parlance we call it EBR, extra budgetary resources. Extra budgetary resources is nothing but hypothecating the asset which you are creating to get the money for its further expansion. And this metro systems across the country, Mumbai suburban system, the only we had created RLDA for that purpose only. That in Mumbai we have got a lot of land, so we will monetize the land, and that money which will come out from the monetization of the land will be put into the development of the suburban infrastructure. And Mumbai, so far we have not succeeded, but hopefully some signs are available that Gaya, there are many stations where urban transit in Ashok Vihar colony in Delhi, we have been able to send a land parcel for 200 crores on a long lease. In Guwahati, we have near station area, we have 80. We have recently awarded around 70-80 crores rupees lease. So that way, our efforts are on, and hopefully, will succeed in a better way in future. Yes, Vikas.
Nice, sir. On this note, on monetization, which was already existent in a different form, and now we are changing into a new form through
Hmm.
a PPP route, or there are various terminologies in parlance. So whichever word anybody likes, the whole idea is to give a share of the railway assets for the private investors to come, and ultimately he should make some money. Let's be very clear, he is not there for any philanthropy, neither
Yeah.
is here for any social cause.
Hmm.
Although railway, since hundreds of years, I would say, have already been doing the hardest task of social service obligation, which they mm, magnificently did during COVID, and they are continuing to do right now. So on this particular note of railway land getting monetized to a large extent, I would now request Sunil Srivastava ji to share his viewpoints on urban transit. Now, Trivedi sir nicely pointed out urban land as one asset to be monetized. With your experience in railway sector for many decades, I would now request you to share your views on which segment of railway assets in urban space which can be monetized and private investors would be keen to join. Yes, sir. Over to you. Sunilji, your video.
My video.
No, Sunil Srivastava ji, your video I think is not online?
As far as monetization or urban transit goes, I have been lucky to have worked in various forms of private involvement. I am a very strong votary of monetization, or as you call PPP. Having been associated with the Hyderabad Metro, uh, which is the world's biggest urban transit PPP happening today, and seeing it reasonably successful. I would not say completely successful, but reasonably successful. And also having worked with the station modernization, which Mr. Trivedi mentioned, having designed some of the stations for both IRSDC and RLDA, looked at what the investors want, and also looking at, of course, now defunct PPP in the railway operations part of it with the train operators. Having seen all this gamut, I feel urban transit is the most suited for monetization. Why do I say this? Because it is a limited place where you are monetizing. So it becomes easy for an investor to cover their risks. It is within a city limit, however big it is within a city limit. And the entire asset is owned by a single entity. The metro company or the metro authority owns all the assets. Whereas, there could be a possibility of, say, in the Indian Railway, the station, the land could belong to the state government or whatever, because there are issues which we have faced while we were planning these stations, that between the ownership of the railways and the state government, there were issues as to who would get the returns on this investment. Whereas in an urban transit, those are very clearly defined. So they are actually very, very suitable. And also why I'm pro monetization or pro PPP is because the development of an infrastructure and running of an infrastructure are two different skill sets. The mindset, the skill required are two different ones. Today, because there is no option, that's why a company like Delhi Metro is forced to also run the metro system, whereas they are very good in execution, and that should be their job because they are masters in that. They can optimize their resources, they can make it cheaper and cheaper to expand, because again, globally, no metro system comes to a standstill. It is always growing globally. In fact, the biggest example, global example, is what is called as the Boston Big Dig, which has been ongoing for 65 years now. I have friends who actually joined their career there and retired from the same project. So it is a continuous process. So learning from that, if you look at Delhi Metro, starting from 10 kilometers today, almost 400, 500 kilometers, and going forward. So that's why you should always separate the two. That is, construction or development should be a core activity, and give out the operation and maintenance to an individual, a group of people who are experts in that. This will also release resources for your expansion, because otherwise all your resources get tied up. So I'm very, very strong votary for that. And I feel that, yes, this government, when they've come up with this, a lot of issues need to be fine-tuned. Yes, it's a very general idea today, but with fine-tuning going forward, I'm very hopeful that monetization to a large extent would be definitely happening. How successful, only time will tell, but I'm optimistic that it will be successful. Over to you, Vikas.
Thank you, Sunilji. So urban space definitely is a much viable area for any investors looking out to join this monetization pipeline, because as you are all aware, in the last year budget, national monetization pipeline is already up and running. There is a separate wing under Niti Aayog where they keep track of national monetization pipeline, which includes various other sectors. Multimodal is my favorite topic, so it includes national highways, it includes power, it also includes railway. But today being our main focus on railway, that too on urban transit systems, and with huge number of metros already lined up, under construction, and likely to come up. So people are looking at the area where metros are to be monetized. And now this brings me to Harshji, who has been in the metro space for what I should say, n number of years, and with such huge experience on rolling stocks as well as all allied infrastructure. Arji, I request you to share your views on what could be the most viable monetization space in urban transit systems. Special focus on the best IRR, which can all the investors are looking out, because anybody joining our Rail and Digi Expo will definitely look on some parameters. I don't need expert to share their financial models on IRR and NPV, but quick pointers on which areas they can help. So, Harji, I request you to please share your ideas.
Thank you, Vikas. I think the point which Lalitji and Sunilji made are very relevant. I am personally very pro monetization as well as pro private player getting into the field of urban transit. In fact, government is also keen that the private investors should come to invest in the urban transit as well as railways. So private investors are also interested to invest. So where is the gap? So first we have to understand from where this gap is coming. So I will just give you some reference numbers which will help you as well as the audience who are listening to this, that where this gap is coming and how this gap has to be first reduced. See, all these urban transit projects today are funded almost 30 to 40% by the equity by the state government and the central government, and balance about 50-60 funding is 50 to 60% funding is coming from financial institutions. And today we have seen it, majority of the institutions which are funding it, they are funding at the rate of 2 to 3% because these are our international financial institutions who are putting the money on this development fund. So if 40% equity of a urban transit project is coming from government with a 0% expected return, I'm talking about financial return, and 60% is coming from the financial institution where the rate of interest is about 3 to 4%. So effectively you say that today the urban transit projects are funded at 4%. And if you compare this 4% with the private player getting into the field, like suppose Hyderabad Metro is the example which Mr. Sunil has given, the expected return, the commercial, I am not talking about the economic return, I am expecting the commercial return. Commercial return expected is somewhere around 12 to 13%. So there is a gap of 4% and 13% which first has to be addressed. How to address? There can be ways and means to address it. First is the realization in the government that the 40% equity which you are funding for this project, it is exchequer's money which you are funding. You could have used this money for other social obligation. So obviously you cannot compare this 40% which you are giving at 0% return, 0% interest to the urban transit, compare it with the 13% which the financial lender will get it from the market, whether equity or debt, depending on 30/70 or 20/80. So this is first gap which has to be addressed. Lalitji also mentioned about IRFC bonds. Yes, IRFC bonds are available for railways. And today, if your IRFC wants to come with a tax-free bond, it is at 5.5%, 5% or 6%. Again, those bonds cannot be compared with the private investors. Private investors still will require about 13 to 14%. So there is again a gap of 8 to 9%. So first is that from the government side, there is a mindset change which is required, that when you are attracting the private investor to come into this field, especially on the asset monetization, you will not expect them to come forward and put their money without a return of all 12 to 13%. So that is the first point which is required to be understood. Second thing is efficiency in operations. Now, first let me see what are the assets which are, there is assets which are pre-asset acquisition, there can be assets which are post-asset acquisition. Why I'm saying pre-asset? Because majority of the urban transit project require land to be first procured by government, whether it's state government or central government. So first, the asset acquisition has to be done by government, whether it is state or central. And post this infrastructure which has been created, that is the time we have to see among that infrastructures, which is movable as well as immovable, which are the infrastructure which can be monetized. As Lalitji also has said, first monetization which is possible is on the station side. All the station can be monetized. It doesn't say that government cannot run the station and commercialize it. Government and private both can run the station and commercialize it, capitalize it, generate revenue from non-fare. Both is possible, but private will be able to generate more efficiently as compared to government, knowing fully well the government comes with a lot of limitations as well as coming out with innovative ideas of financing. All these things are concerned. So if government is able to generate some kind of revenue from the station monetization, that is the first point. And over the period, the private operator which comes to manage the station can share the profit or revenue with the government. Second aspect comes in the immovable. Immovable, when I say, I talk about the rolling stock. In all the urban transit system, rolling stock and associated equipment, which is signaling and all, these are required to be monetized, and the private player will be willing to buy the system and then run those system under operations. When you run the system under operation, you can share the revenue as well as a profit in the way the model can be developed with the government, which is the state government or the metro organization. Keeping in mind that again, the metro operations are having a social objective. So there is always a possibility that the government have to subsidize certain things, especially on the fare side, So there has to be proper compensation method which has to be followed with private player. So these are my initial thoughts. I am pro asset monetization, but the gap which I have mentioned, this first gap has to be understood between the government and the private before we can move on the asset monetization. So these are my initial thoughts, Vikas.
Thank you, Harji. Very nicely pointed out gap. Yes, gap analysis, gap funding, bridging finance, whichever word we like and whichever modes we use it. So this is an area where now I think Rahul ji, who also represents Invest India, and it is one of the most versatile platform to bring all the players together on a unified dashboard. There are I've been through this Invest India website, and it's a very versatile dashboard which brings both the borrower and the investor together. So, Rahulji, I would like you to share your views on how to bring in investors. Luring the investors won't be a good word to use, but bring them to a place where they feel yes, मेरा पैसा लगेगा, भरोसा भी है, और there is a good short window for getting maximum returns. So Rahulji, some views on yours from your side from Invest India on how to give the best level playing field for monetization of urban transit systems. Thank you.
Thank you. Thanks so much, Vikasji. I think, you know, everybody's a senior to me in the panel. They've expressed great views. Let me first, tell you about availability of capital globally. So, when I'm talking about monetization, ultimately I'm talking about, getting the investment back. Actually, really, getting that capital coming back. Who will put that capital? Capital owners will do it. So just to talk about these capital owners globally, around $150 trillion worth of money is available with institutional investors. If I talk about patient capital, because this is infrastructure, money has to come for long term. Only the pension funds, and pension fund, I think we all realize, they invest for long term and they want returns for long term, right? So 30, 40, 50 years is what they want to invest for. They control 33% of this 150 trillion, which I'm talking about. Now, all of this money is actually looking for opportunities where they can find stable returns. Ultimately it's pensioners' money, even my money, wherever it's going, I want my pension money to be safe, right? Should not be too risky and should be able to generate a constant return over a period of time. So two things here. In whatever we are trying to monetize, one, it should give regular returns. Pension funds or institutional investors called it yield. And the second point here is risk, right? It should not be volatile, right? Which means risk should be as low as possible, right? For PPP, the mantra for PPP is pass on the risk to that party which is best able to absorb it, right? Or best able to manage it. That's the right word. Those I feel are the most important elements for monetization in any field, whether it's railways, it's roads, it's power, whatever it is. Now, specifically coming to railways for monetization, I think a lot of times we have tried, and there was one Delhi Metro project. That was not a monetization project; it was a PPP project, and I used to love to call it PPP in rolling stock, but it was very similar to how a monetization would look. And I work with Mr. Dhingra very closely on that. What happens is that to build any asset class in any country, what we need to do is we need to build capacities. Those capacities will come for manpower. Those capacities will come for technologies and capacity to understand as well, right? So when we did that metro project, we went to a lot of players. We explained that, this is going to be a future for India. We will have a lot of these rolling stocks, which can then be, we'll have new rolling stock as well as existing rolling stock that can be monetized, which means that, and to the point which Mr. Srivastava was talking about, that, operating and maintaining that can be a huge business in itself, right? Now, when you're going with that project for the first time, most people will say, I don't understand it. There are not enough engineers in the market, who I can hire, because most of them are employed by Indian Railways or employed by Delhi Metro. So, any private player, private fund which is trying to hire those guys, they will feel, where will I find those engineers who will manage that stock, that coach? Or where will I find those drivers? Because they're all employed by either Railways or Delhi Metro. and they will have, it'll be very difficult to hire them or bring them on our board. So investor gets a little fidgety and he says, okay, the risk is a bit high, so I want to ask for extra returns from this. So some people will take that bet and say, okay, I'll do it, but I don't want 13 here. I want 17. This is the first project. It may succeed, it may not succeed. With Delhi Metro project, we could not take, so that 2 bids came and, it could have been accepted. Delhi Metro did not. And they said, it's expensive. And they did not accept that bid. What it does is those 2 investors who were really there, they decide, most likely they will not bid for it, or they may bid for it, but this time they'll say, okay, it may again get cancelled. So I'll not ask for 17 this time. I'll ask for 19 this time. And that vicious cycle keeps troubling us over long term. Here I want to tell you the idea of, and I'm sure a lot of people from railways will be listening to this, or this feedback can go. I want to give you the example of both renewables and roads. What has happened in those 2 sectors? I think the earlier road projects, we used to blame them, right? Delhi Noida toll bridge or the Delhi Gurgaon toll, we used to blame those early toll roads, saying that they were so expensive, people had to pay so much. But then came a time that pretty much every project has private participation today, whether it's roads and renewables. And right now, if you look at the TOT model, which is going on in roads, it is getting bids at 8-9%. That's better than a lot of metro companies will, most state-owned metro companies will not be able to raise money at that rate at which those road projects are getting capital. I think understanding this is very important. We need to handhold investors. We need to pass on the risks which they can take, and initially maybe lower risks than what they can take right now. You bring them in, create capacities, and then you push them that now it's the time you take more risk, you give me better return, and that's how I will create value in long term. See, we need to see this entire monetization piece as a 100 billion project and not as a 100 million project. I think once we do that, the value which is available here to create is humongous. And railways, and one last point I want to make, I feel any asset class within the railway piece or within the urban transit piece, I can allocate revenues, that piece can be monetized. It's parking, it's stations, it's escalators, it's whatever it be, that can be monetized, right? There are different players in the market which are already there, and then we can create players in the market to create those businesses, and that's how it works. I want to take this example of when in US, for instance, there are so many vending machines which are billion-dollar businesses, and then all these vending machines are in offices and railway stations. They're all making huge money. In India, we are yet to create that business in that model. So what I'm trying to say here is that everything is possible if I have revenues available. Risks we have to allocate properly. Thank you so much. Sorry, it was a bit long.
No, no. Thanks, Rahulji. That we really wanted your piece because all ideas may come left, right, center, but where is the money to feed all those ideas? And that is where West India comes in as a very big prime mover, I would say, because there have been various platforms on your portal wherein things have turned the other way. As you rightly pointed on the road sector, the turnaround in the road sector at 8% has happened through big effort from Invest India. At the same time, I would now take liberty to slightly probe more deeper. Now, having said the whole agenda and having read through everybody's viewpoints and discussed, if I can share one of the screenshots available from the National Monetization Pipeline, just give me a minute. Yeah. So this is volume 2 of the Railway Asset Monetization Phasing Plan, which was prepared by Niti Aayog. And most of these points we have covered, but as already mentioned by Trivedi sir and Sunil sir, railway station development continues to get the maximum share of almost 76,000 crores, followed by DFC, dedicated freight corridors, and followed by track OHE InvIT. Now, this is something which really caught my attention because OHE has been going on in a very big way, and definitely followed by passenger train operation. So I would now request Trivedi sir to share some more ideas on this railway station development, the outlay, as well as DFC. DFC is one of the most ambitious project which is really going well in spite of initial delays. So, sir, if you can just share some more ideas on DFC and passenger train operations. I will now stop sharing the screen so we can hear your viewpoints.
I was listening to Mr. Dhingra, Mr. Rahul, and Mr. Srivastava. I just wanted to share two snippets from the history books that how within 10, 20 years, Britishers, they increased the rail network from nothing to almost 40,000 kilometers. And in those days where the capital was scarce, not the people like Mr. Rahul were not available, and still they could manage, and in very difficult parts of the country, they could manage all these infrastructure. So I was reading that book that how did they accomplish it. So they introduced the concept of viability gap funding. So they said that anybody from England or Europe or anywhere in the world who puts money in laying tracks in the country, he is assured of 5%. Now they said that if the person makes money more than 5%, then he will pass it on to the government. And if it is 5% is assured. So because as Rahul said that many new escalators, vending machines, and their retiring rooms, your restrooms, and so many facilities they come up in the station that you do not know that how far though although today they are not visible, but these revenue yields might become visible more pronounced in the future. So if the entrepreneur is guaranteed a basic interest rate for his money, and thereafter, and if he makes money more than that, then he shares, then government takes away that. So that will provide some relief to the person who puts in the money, as the Britishers did. Second thing, particularly in metros like Bombay, Calcutta, and other areas, the FSI is a very big tool in the hands of the government. It's making money not from the land but from the sky. So you permit higher FSI to the suburban projects for building the commercial infrastructure over the station building and other areas, and you can make a lot of money. As regards now coming back to you raise the subject in fact, and the DFCC and this our other assets, how to monetize, we had introduced the concept of track access charges, OHE access charges. So you bring your rolling stock and you use our network for running your freight train or private train and pay us the money for taking your train. It's something similar to the toll which you put on the road. Instead of putting toll on the road, you a virtual toll on the rail network, and you pay a sum to the rail running authorities, rail operating authorities, which is called track access charges, which is so. And in fact, OHE, we are talking of INVET system. And for track, we are track and signaling, we are talking of the track access charges. Unfortunately, the private uh, train tender, it had some basic issues. It didn't materialize. But the same way, my idea is that why you do it, you to provide visibility to the person, you use the today's Rajdhani Express. Because if I want to put my money, I know the Bombay, Delhi Rajdhani, Bombay, Kolkata Rajdhani, they are making money. So I will put my money. So because it has the visibility. Now don't ask a person who doesn't know railways, who doesn't know, who is only a person who's sitting on the capital, to invest money in areas which do not have the visibility. And if they have, and if you can, if you want them to go in that direction, then assure them with the return which Britishers assure them of basic returns for laying the tracks or for whatever investment they make. That is what my point is. Over to you, Vikas.
Nice, sir. Yeah, very nicely put in. And now, few more, what I should say, with such an august panel, dil mange more. So I would like Harji to share more ideas on how to monetize rolling stocks, because rolling stocks we are having a combination right now, wherein there is a Atmanirbhar manufacturing initiative also, where rolling stocks are manufactured in India, they are exported also, they are used for captive consumption also. So any way to synergize Atmanirbhar manufacturing also, and at the same time utilize it as a part of asset monetization exercise. This is asking for something as on a different note, but Harshji with all his experience can share some thoughts on this.
Thank you, Vikas. I think the options which are available, especially for urban transit, I will keep railway side at this moment, because urban transit is dedicated network, dedicated rolling stock, which can be operated and maintained for a particular period of time. So the options which are available today in front of the metro organizations, including the government, state government or central government, are two. One is for any new acquisition of rolling stock to be run on a track. I'm not saying about the asset. Asset means fixed asset, including the stations, OHE, track, that government can take care, which constitute almost 60 to 70% of the total cost. Balance 30% can be taken by the private player. And what private player has to bring is, they have to bring the rolling stock player as a partner. And along with the rolling stock player, they have to take care of the maintenance for the next 30 years. And also the sweetener can be the complete operation of the line can be given to the private player. So advantage of this is that you are operating, you are bringing efficiency in operation, you are maintaining, you are getting the rolling stock, you are maintaining the rolling stock over the life of 35 years. So there is interest of rolling stock player also, there is interest of operator also. So both these idea can be addressed there. So that is one option which is available in front of the government. But keeping in mind, as I said earlier, please do not consider the 4% return which you have got, 4% cost of capital which you have got when you are funding on your own, because the cost of capital will be 12 to 13 to 15% depending on the risk perceived. That is one thing which has to be seen. Second option which is available is, like Delhi Metro is having today 7-8 lines running. Give one line. You have already acquired the asset. You have already procured the asset. Assets are running. Give that asset to the private player. What private player can bring in, they will give you upfront cash for the asset which they are acquiring. Use that asset, maintain that asset, and run that asset on that particular line, including operation which can be given. So what advantage that you get, you are able to freeze the blocked money and use that money for some other purpose, for your own further development, for your own infrastructure development. That is something which can be done. The catch here is, in both the issues, the catch here is whether the private player is able to take the risk of the traffic. That becomes very important. If private player is able to take the risk of the traffic, nothing like it. But today, when we know fully well, all the metro organizations are subsidizing the rates, the fare. When your fare is almost contributing 70 to 80%, especially in these kind of rolling stock and operation and maintenance, almost 80% is coming from the fare only. So if you are getting everything linked to the fare, it will be very difficult for the private player to generate revenue or generate profit from that. So what is option available? Mr. Lalit also just now mentioned about the 5% factor which he has indicated. I go at 80 to 120%. Guarantee 80% traffic. Let companies come forward, supply the rolling stock, or buy the rolling stock, maintain it and operate it, and you guarantee the 80% traffic which is already available. Anything above 80% is shared, 80 to 100% can be shared in the same ratio between the government as well as private. If it goes beyond 100%, the share ratios can be different. So that will be the interest of the private player, that, okay, 80% of the traffic is assured. I know my money will get back because lenders will be able to get back the money. And anything above that, whatever we generate, we share with government. So that is the option which is available. And I think if that can be tested, they try to test it, as Rahul mentioned about DMRC in one of the line, when they said, okay, we will lease the rolling stock. But why it failed? It failed only because of the gap which I initially mentioned. They were expecting 4 to 5%. People came with 14%. They said this gap cannot be addressed. So if that gap is reduced by giving that kind of a guarantee, that will bring private player to come forward and invest in it. Rahul has rightly mentioned, road 15 years back was nowhere. Today, almost 100% road is on the private side. Similarly, I believe if there is an open mind from the government side, as well as an open mind with the private investors are ready to invest in government and these kind of projects. But they want some kind of assurance. And that assurance is the risk that they see on the traffic side, because majority of the time they say the fare structure is not in their control. Fare structure is in control of government, and there they will not be able to make money over a period of time. So these are the options which are available in the transit, urban transit. Last point I just want to make on the railway side here. Railway side is also possible. In fact, that is the way it started when they went for privatization of train operation. It was also feasible. But Mr. Lalit mentioned about one route, Rajdhani route. But what government said, we give you a cluster of 12 routes, and out of those 12 routes, there is a possibility that 6 routes or 7 routes are unviable. But you carry the subsidy of these 7 routes from the one route which is economically viable. So finally, people were not keen to go ahead with this kind of a untested model, thinking that again the risk of the traffic is coming to the private player, and we have seen what happened to that project. So as if both government and private player jointly work on such a condition that okay, revenue sharing or profit sharing can be done with a guaranteed availability of traffic to the private player, I think this kind of possibility of asset monetization is possible. These are my views.
Thank you, Arji. So very nicely you pointed out the new clauses, if I can put, which we can include in all future model concession agreements. Because ultimately, whichever word you call, model concession agreement originated from the highways and road sector, the same type of agreements we can have where these clauses, these suggestions can be built into to give a level playing field for everyone. And now coming back to Rahulji again, how to bridge the gap? The $1 million question is bridging the gap between 4% and 14% through non-fare box revenue. Now, many metros, while preparing their viability reports, have done away with only fare box revenues, and they have now given a mixed model of fare as well as non-fare box revenue to make the metro projects. I'm talking about metro because we are talking on urban transit system, make them viable. Now, with such non-fare box revenues available to investors, do you think or do you foresee people will buy that idea and come forward to any type of models? And second is some of your views on the InvIT structure to be incorporated in the railway segment. InvIT is very much up and running in the road sector. So, Rahulji, your views on this?
So thank you. I think it's a very interesting question. Part of it I answered, but I think I'll take a shot at it again. So the difference between 4 and I don't like to say 13, I like to say 15, or even on the steeper side, because metros people want comfort. So this 11% gap, a part of it is perceptive risk, right? People believe railways is risky, right? And I don't want to mince my word. It's a reality. People, you go on the street, talk to investor, they'll say, one infrastructure sector which is very risky is railways. So I'll go to roads, I'll not go to railways. So the first address this perception gap. So there are a lot of risk, and I'm sure at least about 4 to 5% of this is only because of perception issues. How we can do it? We can do it, we need to prove it on the ground that we can give returns effectively without passing on risks. And when I say risk, I mean without passing on any surprises to the investor. So if you are able to do that for 3 years, the perceptive risk, the perception risk will go off. So we will come to 11. From, and this difference between 4 and 11, I think this will never get breached. And Mr. Dhingra actually answered that question before, because, government is giving risk capital, but not calculating the return or not calculating the cost of that risk capital. So even for government, there is, this capital doesn't come at 4% or 0%, right? It actually comes at 7-8%, or maybe in some cases 20%, because they could have used the capital somewhere else. So, and for any private sector to get involved, they want some return over and above the risk-free rate. Sorry, bringing in economics, right? They want some risk premium. That's why they are taking that pain to come into, taking pain to invest. Otherwise, everyone will be happy to put money in government securities. 7% is coming. Why to invest for 10 or 11? So that is where I think we need to settle down and realize this is going to be there. So that's the first point, and it has to be a long-term strategy. I'm saying that point again. We should not look at it, only for one project. We need to look at it over a period of time. The second point, I want to add one point on private train operations. I think what we did right there was to first come out with the model. It was actually a good model. The only thing we could not do well was to explain well that, this is how the future will look like, and put all of that future which we thought on the paper. And that's where everybody got confused and they thought surprises will come. So, the right kind of people did not come forward. I'm being very brutally honest about it. So that's the point in private train operations. Coming to InvIT piece, just taking what I said earlier, whatever you can allocate revenues to. So if I think that I can pay for OHE in a predetermined formula, right? So, ultimately what investor wants, that the returns which are coming to this model is in a predetermined formula. It means, how much I'm using this OHE. If I can say, okay, these many trains will go, this much for every train, or, this much electricity will flow, so this much for return. Or if I can't say on all of these things, then I should say, okay, this OHE is available. This is yours. I will pay you a fixed 7%, 8%, or you tell me how much you want. You want 7, you want 8, that can be the bidding parameter. And against that, you will also maintain. So if I can put the model in any of those three formulas, people will come and invest. People are looking for that 7, 8% number, and putting it into InvIT, all the more better, because then I am not reliant on global investors. I can put my own money, and then invest into, these assets. So, and people are chasing for such assets. Right now, 8%, 7% is not available, right? So that's what we need. I just want to add one more point, which I started telling global investors. Look at our NPS. NPS has already become 7.5 lakh crores, right? This is $100 billion. In 10 years from now, this NPS is going to be $500 to $600 billion, right? And the day it becomes that number, I don't need foreign money because my own money is available. Then why should I offer these pension funds 20% dollar returns, right? My own pension funds will invest in these assets and I'm done, right? I will be very, very happy, and my money will then generate 8, 9% over next 30 years. And when I retire, then that Delhi metro train, which is running on the tracks, should pay my pension, right? That should be the thought process. And thus we need to start using models like InvIT and others on we need to promote it, and our pension funds, our EPFO should invest into it. That's how I see this, this entire thing unfolding.
Thank you, Rahulji. It was very nice to hear you out on what should be the feel-good factor, or something for the investors and people joining our Rail and Digi Expo, that all is not lost and it is not a bad scene at the moment, and keeping away from railways, because railways definitely is going to be the main prime mover for coming decade as far as freight is concerned, as far as passenger is concerned, and its multimodal connectivity. Because you take it port, it could be seaport, it could be inland waterways, or it could be even inland dry container ports. All of them are going to get connected through multimodal connectivity. PM Gati Shakti, which was also launched last year. And this brings me to Sunil ji, where he has done a lot of feasibility studies on various infrastructure projects, including railways. So feasibility study is the starting point to give a feel-good factor for the investors to come in. So Sunil ji, some quick viewpoint from your side on this topic, and then I would request Trivedi ji to sum up our session for today.
Yeah,
Sunil ji, can you hear me?
Take on points. I will take on points from what Mr. Trivedi, Harsh, and Rahul have said. I have been associated from the outside view with most of the privatization bids of the Indian Railways, as well as from the so-called metro authorities. So I can give a viewpoint in terms of why there was no interest. Taking off first from Rahul, I think the first thing which needs to be done is capacity of understanding monetization or PPP has to be built into the railways. Unfortunately, they have not willing to, or they've not learned from the telecom sector. They've not learned from the highway sector. They've not learned from the aviation, where UDAN is a successful scheme, where VGF is given. So I'm a bit amazed as to why the colleagues sitting in two different bhavans can't talk to each other and learn from that. So that is my first worry. unless that happens, because till now the thinking in the railways or the metro authorities is not what Rahul said, that the person best suited to handle the risk in a PPP should be the one. No, it's the other way around. Most of them have thought as PPP as a magic wand, that if I can't do it, I'll pass it on to the other and somehow he will do it, which is a totally wrong way of looking at a PPP or a private investor. After all, like all of us agree that private investment is not charity. Private investment is investment for returns, and they have no love lost for India, or they have no love lost for railways. So why would he come here if everything is risky? So that is because these are things we faced. To answer, for example, Mr. Trivedi said that there was no successful bidder for the.
Sunilji, we lost you. Sunilji, can you hear us?
From the client's perspective, from the investor's perspective, and then only we can expect that yes, there would be interest from there. So that is one part of it. Now coming to the other aspect of what Rahul said, my personal view is none of the investments today have actually foreign component. All of the projects which are funded, at least in the metro sector, are all funded through Indian money. So there is enough money, all funded by Indian banks. Alstom's factory, all funded by Indian banks. Sarguja Rail, one of the big private railway sidings, funded by Indian banks. Because we have been associated with these projects, so I can tell you confidently that none of them have sought foreign money. Indian money is available, provided these risk-sharing mechanisms are actually handled properly. Now, once that is done, I'm sure people would be willing to come forward and look at how best to invest, get decent returns, not unreasonable returns, but get decent returns. Sit down together as partners, not as adversaries, but sit down together and see how best. Because even today, I think the monetization plan is not able to address that part of it. The capacity part of it, even today, they have not been able to address. So that is something, unless that happens, I don't think there would be any great queue for investments, whatever the government might think. They first need to build in that capacity, at least in the railway or the the rail transport sector, both from the metro side. Otherwise, what Mr. Harshji said, that people will think that it's too expensive, so I can't afford it, which is not really true. The whole life cycle cost, if it is considered, I'm sure it is much more economical for them to actually get a private investor and use the money available for other projects. So this is something which I think has to be really looked at in a totality, which is what Rahul said, that not as one project, but as multiple and long-term, next 15 years or next 20 years kind of approach, and then see what correctives need to be done. That's my take on monetization. Over to you, Vikas.
Thank you, sir. Thank you so much. And now, Trivedi sir, I would like you to sum up, being the most senior amongst us, on, I would still repeat that word, give a feel-good factor for all the investors who come here, quick pointers on preparing a SWOT is too asking for too much, but some quick pointers on the strength and the opportunities available. And I think that should be a valuable piece of information that you can share with all of us.
Yeah, thank Vikas, and thanks Sunil. I heard Rahul and Mr. Dhingra, they are all old friends also, colleagues also. Actually, the basic thing is that the government mentality of that we know all has to go away. I was always telling when I was that the powers that be, when I was in the power, that we know a certain portion of the game. The person who has to put in money, his point of view must be there, figure in our bid document. Now, if most of our bid documents are one-sided, they ensure that the all interests of the government sector are ensured, but they do not know that the person who is putting the money in the first place, his interest also need to be secured. So unless you secure the uh, fears and the interest of the person who is putting the money in the first place, none of these schemes will succeed. To give you an example, when I was in ICF, so what I used to do when awarding the major contracts, because there used to be always allegations that you have helped this party, you are you have designed the bid document in such a way. I used to pick the three most visible players who like Tata Projects or some other some basic people who know the subject very well, and I should tell them that you may these are my codal books. You make the bid document. So I made the bid document based on their draft bid document which I received, and then it used to be discussed threadbare in the pre-bid meetings, so that in pre-bid meetings we ensure that no particular person is getting advantaged or is getting undue advantage. So once the process is transparent, interest of the person who is putting the money are ensured, and government gives the security of the visibility. And as I said that uh, unless the visibility, the distance, how far, because when here we are talking of not 1 year or 2 years money, here we are talking of, as Rahul said, 30 years or 40 years. The visibility for 30 and 40 years only government can give. No private institution can give you visibility for 30-40 years. So the government sovereign, if not the exact sovereign guarantee, but at least the implicit sovereign support for the scheme where the person is putting the money has to be there. And in fact, I was just going through the figures. I found in 2003, the rail network was 63,000 kilometers and road network was also 63,000 kilometers, incidentally. And today in 2022, our rail network has gone from 60,000 kilometers to 70,000 kilometers around, and road network has gone to 1,42,000 kilometers. And that it's today almost double the rail network. And here we are talking of increasing the market share of railways into the overall pie. Here, even to secure the existing pie is becoming difficult. So, unless the issues which Mr. Dhingra raised, which Mr. Sunil raised, which Mr. Rahul raised, unless those issues are taken care of and comfort is provided to the person who is putting the money, and as we have already said that there is no need to bring foreign money. Our own NPS and other so many, as Mr. Sunil confirmed, that today we are not a beggar. We are funding countries like Nepal, Sri Lanka, and so many other countries. We can fund our own projects, provided even I will not put my money. You forget the private institution. If I have to put my money, I always ensure that NSC or some other scheme which guarantees me that Pradhan Mantri Vyay. So when Pradhan Mantri Vyay Vanjan Yojana is there for the or senior citizens scheme to guarantee us the 7%. So something similar should be given to that private player also, so that he has the courage, and you put that clause that if he makes money more than that, there are various ways. Mr. Dhingra brought out way of 80% traffic. There can be many formulas that this minimum is guaranteed to you. If you make more money, you will share with us, so that it's a win-win situation. So in the concluding remarks, I will say that all of us have got, and fortunately we have got, as our experts have pointed out, very good success rates in telecom, in roadways, and in so many other areas. There is no reason that we cannot succeed in, and I'm particularly passionate about railways, because railways has to succeed also to get our environmental goals. Because of its 1/7 consumption of energy per unit of throughput of the transportation, it is essential. It's in the interest of all of us. The sultry heat which we are facing, 48-degree temperature in all over the country, railways as a transport sector can bring that down very much. In fact, I hope many of you are maybe aware that France has put a ban that if two destinations can be reached within 5 hours by a train journey, you will not have a flight in that this thing, because flights are 15 times more energy consuming. Roads are 5 to 6 times more energy consuming. So let us hope that whatever discussions which we have done today leads to increased visibility, increased assurance on the part of this investor, and they feel secured, they feel confident to put their money into railways. Thank you.
Thank you, sir. Thank you so much for nicely summing it up. It's a request to all the stalwarts out here to promote national monetization pipeline in a big way, and a suggestion that Invest India can help us by organizing a workshop on creating awareness on how to monetize various assets, explaining both the financials as well as the technical aspects and the operational aspects. And you already have links to so many of experts around who will be happy to come and give their viewpoints on a 1 day or a 2 day workshop as a sequel to this Rail and Digi Expo. It's almost an hour that all of you have devoted your time, and thank you so much from the bottom of my heart. And with request to all of you, let's meet once again. Jai Hind.
Thank you. Jai Hind.